Well, Mike and Ryan, listen, I want to thank you guys for taking some time out today on this. It's actually quite a blistery, wintry wonderland. I think the whole city's going to get ready to shut down. But anyways, I'm glad we were able to make it for the call today and have a bit of a chat about the fourth quarter of 2018. It was sort of an about face, so to speak, and I think everybody's interested to sort of hear what the thoughts were, some sort of insights into what happened, what drove things, what started things, but really what the outlook is and what plans are going forward and what strategies are that we can employ, when events like this take place. So maybe I'll pass it over to you guys, and we'll go from there.
Sounds good. Thanks, Scott. Yeah, that's right. Schools are shut down all around the city, but nothing's going to stop Ryan and I from coming to the office to give you this market update. So we're here and ready to go. I thought I'd just kind of, as a reminder, we haven't reviewed this with everyone in a while, but just as a reminder, this is the Connor Clark and Lawn Investment Platform, and I think everybody knows that we manage money for large pension plans, foundations, endowments, high net worth, ultra high net worth families. This is our toolbox, if you will. If you think about a handyman coming around the house, there's different tools that will be needed to fix things up around the place. But this is our comprehensive investment platform. So we can essentially invest in everything in the traditional markets like stocks, bonds, cash, right around the world. And then we have 5 different alternative investments that we talked about over the years. So we'll touch on all of these different things, what we think will do the best moving forward, where our biases are. But a lot of our discussion, and Ryan's going to cover a bit of a market update after I cover some performance highlights. But you can see that we really try to track the business cycle. And there's times where you're in an accelerating growth phase, and there's certain asset classes that will outperform those markets. And then you kind of hit a peak growth rate, and then you start to have this downside inflection point, and maybe growth starts to decelerate. And that's kind of where we're at. We're somewhere around here on the curve, on the back end of things, which means we're moving towards a recession. And when I say that, that could be 3 years from now, that could be 6 months from now. And so we have to look at all the economic factors and everything that's taking place really closely to try to predict that. We still think that this is the recession's a few years away. And so we'll talk about how we're positioned accordingly. But, the way things work in the economy and politics, a few different decisions happen that we're not expecting, and all of a sudden we could be in a recession. So it's something that we track very closely. But I just thought I'd give that overview around how we try to make decisions. What we'll cover today is similar to what we've done in the past. Cover some performance highlights. I'm going to discuss that. Ryan's going to talk about some economic factors driving the markets, investment market themes, and our outlook. And then I'll close off with our portfolio positioning. And Scott, as always, feel free to ask any questions.
Yep.
So quarter 4, not a great quarter. 2018 in general, not a great year. The year can be defined by 4 market corrections. And when I say market correction, I mean 10+% market sell-offs. Anything in the 10 to 20% negative range is called a correction. Once it gets worse than 20% on the downside, it's called a bear market or ultimately a recession. And if it gets really bad, like down 57%, then it's called a great recession, like what we experienced in 2007 to 2009. So to put it in perspective, a correction is not a big deal. This should happen every say 15 to 18 months. That's normal. But we had a period between 2009 and 2016 where we only had 3 corrections in that entire time frame, which was rare to the positive. Then for 2 years we had nothing, no correction. So actually, if you look at 2009 to the end of 2017, we only had 3 corrections in that entire time frame. We had 4 in 2018. One in January, one in March, one in October, another one in December, and we had one in October, one in December. So that's all within this quarter 4 time frame. So when you look at these numbers, Canadian equities down 10. These are 3-month numbers. U.S. down 8.6 in Canadian dollar terms. International down 7.5. The only thing that did reasonably well was bonds, and that's because interest rates started to drop in the later part of the year. In October, that wasn't the case. Interest rates were still going up, and so bonds were still looking pretty negative. Stocks were looking negative, but to finish off the quarter, bonds ended up being okay. These numbers, for your perspective, are just for the year. So you can see the TSX closed the year down 9%, US up 4 in Canadian dollar terms. A lot of that was currency impact because the US dollar strengthened last year. International stocks were down almost 6, and bonds were only up 1.4. So not a great year. Certainly 2017 was a lot better. And already 2018 has shaped up to be a whole lot better than the entire year in 2018. TSX had its best year in about 40 years in January. So, when things go down, they tend to pop back up. So, but, rising interest rates, that was kind of a key. The U.S.-China trade discussions has certainly been a key factor. And from one day to the next, if there's a positive piece of news around those two items, we'll see the markets move up. If there's negative news around that, we'll see the markets move down. But another theme is that global growth is generally slowing. Slowing growth is not necessarily a bad thing. It just means that we can't expect 10+% returns out of stocks. Maybe 5 to 6 is maybe more the norm. Looking at 2018 another way, almost nothing, was unscathed in that year. You could have made money if you invested in U.S. dollars last year. You were up 8.3. Short-term bonds, core bonds were up a little bit, but you can see that everything else was negative last year. And if you invested in oil, you certainly weren't very happy. And Canadian small companies, which have a lot of smaller energy companies, smaller mining companies, they got that asset class got hit the hardest. Fortunately, that was a significant underweight for us in the portfolio last year, but we did lean into that a little bit at the beginning of this year, and that's been a positive so far. Another chart that doesn't make you feel really good about quarter four, everything was negative. This is all in local currency terms, mind you. So the U.S. did have some positive returns, better returns in Canadian dollar terms because the U.S. dollar did strengthen. And this is just for quarter four. So pretty much no place to hide last year in quarter four.
Yeah, well, I mean, that's the first time we've ever seen that chart where everything's red.
Yeah, and this is over a 3-month time frame, mind you, not for the year. I'll show you the year, which gives you a bit of a different perspective. But yeah, I mean, there are times in the markets where nothing's working. Like 2008 was an example of that, and there was no place to make money in the stock market. And quarter four was nowhere near the same to the negative, but certainly it didn't feel good. Here we're talking about how market leadership has shifted during the quarter. So, in the gold, you can see what happened in quarters 1, 2, 3, the first 3 quarters of the year. The purple is what happened in quarter four. And everything that worked in the first 9 months of the year didn't work in quarter four. So cyclical stocks were down, defensive stocks were up, growth stocks were down in quarter four, and more value or higher dividend stocks were up. You can see how the U.S. did very well in the first 9 months of the year, but poorly in quarter four. Same thing for international, same thing. And for emerging markets, interestingly enough, they were down for the first 9 months of the year, and they were up in quarter four. So it kind of shows you how diversification really does matter and how quickly things can shift from one theme performing to another theme performing. Now, just looking at these same numbers for the year, TSX down 8.9%, international down 5.6%. U.S. was certainly the right place to be, and that was an overweight for us. We were overweight global equities in general versus Canada, and we were overweight U.S. within the global sector. So those calls at the margin certainly did help. Bonds at 1.4, not a great year, but certainly a lot better than Canadian stocks or international stocks. Stock market returns for the year, again, in local currency terms, the U.S. market was one of the markets that was up last year, and that was in Canadian dollar terms. But in U.S. dollar terms, they were down 6%. Canada down 12% on the whole, and you can see right across the world it was a pretty dismal year. Hopefully this puts into perspective. I mean, most clients would have received their December 31st reports by now, and none of us are happy to see a negative quarter, a negative year. And even just looking at the change on the 1-year numbers at the end of December 31st compared to just 3 months before at the end of September. At the end of, if everybody goes back to their September 30th statement, you're going to be looking at some numbers that you were pretty happy with. Why? Because quarter four 2017 was really, really good. Quarter four 2018 was really bad. And when you shift from September 30th to December 31st, you lose that amazing 3-month track record from 2017 in quarter four, and you gain a horrible quarter four from 2018. So it really shifts the numbers to make you feel like it's a lot worse than it is, but it's just 3 months difference. And quarter four was negative, but already we're seeing things recover very quickly. but it just kind of speaks to the in-date sensitivity of how you look at numbers and how you perceive your results.
Yeah, and that's a good point, because one of the things that I think is important just from an analysis standpoint is to analyze things over complete business cycles, because so many changes can take place in a short period of time that something that the exact same portfolio can look great in one quarter and not so great in another quarter, and people go, oh, well, it doesn't look good, I'm not happy with that, or other quarters go, oh, this is great, but it's the perspective, it's the time frame. I saw an interesting chart that showed 4 different investments over a 10-year period, and the question was, which one do you want? And, one of them 10-year period was up 150%, another was down 45%, and they were all over the map. And what the article didn't tell you at the beginning was that each one of those investments was the same investment. It was the U.S. market over different 10-year time periods. So but it just speaks to the fact that it's you can't say, oh, well, that's now a bad investment. It's just the market cycle. And you've got to you've got to take a longer term perspective on that to let let things sort of work their way through. Yeah,
no, I hear you completely. So this just kind of summarizes what worked, what didn't last year. I mean, our asset mix generally worked. We were overweight in global equities versus Canadian equities, and that was the right move. U.S. was our kind of top overweight pick, and that was the best performing market. We added a little bit to core bonds before the recovery in Q4. So, we made a bunch of shifts throughout the year that helped, and we took some risk off the table on a number of occasions throughout the year as things were getting more volatile. Canadian core equities and Canadian value equities underperformed, while Canadian income or dividend stock investments outperformed, and you can see that in these numbers. This gives a lot of detail, this page, where it's showing here's your annual results. Purple is the market, gold is our portfolios. So all of our bond portfolios outperformed the market, which was good. There's the numbers for Q4, if there's some curiosity around that. Obviously, you're going to see a lot more minus signs for Q4. For the year, the TSX was down 8.9. Our dividend stock portfolio, or income and growth, outperformed by a good margin. The other portfolios underperformed because anything that was leaning towards growth in any kind of way, shape, or form underperformed in a big part because of Q4. As I said, everything shifted between the first 9 months of the year and the last quarter. And the last quarter really recognized dividend stocks. Anything that felt safer is what did better. Small caps on a blended basis were now 4.5. This is a mix of Canadian small companies, which were down the most last year, but it was our biggest underweight, and growth stocks. And here's the global small caps, down only 2. There's the global markets up 0.4. We outperformed by a large margin in our income and growth, or our dividend stock portfolio, and we outperformed by a little bit in our core portfolio. US up 4.2. Again, you can see dividend stocks outperforming significantly. And we were kind of more in line with our growth stocks. And then for the international markets, we outperformed by 3.5%. So very good outperformance there. Probably our biggest disappointment last year was multi-strategy. And we've talked about this portfolio in the past. It's designed to get a 6+% rate of return with 6% market risk, or let's call it bond type market risk. And it's done that very well over the long term, but the last 2 or 3 years have been a little bit more challenging for this portfolio. And last year was the worst annual return that we've had since 2000. Well, that's actually the worst annual return we've had. 2009 would have been similar. But really, it was the year where high quality stocks were not outperforming poor quality. And this portfolio really relies on us to be able to pick high quality to outperform poor quality. And last year didn't make a lot of sense in that regard. But already things have shifted to the positive. December was a great month. January was a great month. February is off to a good start. So we're seeing a bit of a shift where we expect this portfolio to add good relative value, certainly relative to bonds, which is how we allocate to this. And then you got real estate, infrastructure, private loans. Those are only 9-month numbers that you're looking at there. If you look at the numbers on a 1-year basis, the returns are over 10% returns for real estate, infrastructure. Private loans are trending to about an 8% return. And the actual numbers: real estate 1 year up 13.4 ending September, infrastructure up 10.8, and private loans on a 1 year basis up 8.3. So those asset classes have added a lot of value, and we'd expect them to continue to. I think all of us need to think about, when this next recession hits, what kind of portfolio do you want to be sitting on? And our view is that these asset classes can add a lot of value on a risk-adjusted basis. So I'll turn it over to Ryan. We'll cover off the investment market themes and our outlook moving forward.
Thanks, Mike. So we'll look at some of the data behind the numbers that Mike just went over. We'll start with the stock portion of a portfolio, and here you'll see each quarter broken down for the calendar year going back for 2018. You'll see where we started. Now, this is based on a balanced equity portfolio, so normally 45% invested in Canadian stocks and 55% invested outside of Canada. And you'll see how that journey played out for the year. Relatively weak start for the first quarter, down modestly about 1%. And you'll see some of the triggers over that period of time, whether that's tariffs announced on China or the first increase by the Federal Reserve Bank in the U.S. That set the stage for a good and solid second quarter, where equities were up on balance just over the 5% mark. You'll see again towards the end of that quarter the Fed raising rates again. Q3 relatively flat. We saw the Bank of Canada raise rates early on, and then we saw the second wave of tariffs again, and then again another rate hike towards the end of that quarter. That rate hike coincided with the peak of the equity market, and if you see that peak in Q3 towards the end there, an equity portion of a balanced portfolio was up just shy of 6% on the back of some comments made by the chairman of the Federal Reserve in the U.S., and that prompted some volatility that we saw in the fourth quarter, with equities down on balance about 9% or just over 9%. And you'll see again at the end of the fourth quarter the last raise in terms of interest rates, which also prompted that real dip in the market correction going into the end of the year. So overall, the return for the year on the stock portion of a balanced portfolio, negative about 4% for the full year. So as we look here, we've talked about the recovery, and I think we've also mentioned in the past that we believe recoveries don't necessarily die of old age. And if you look at where we are now in that goldish greenish line, you'll get a sense of our growth cycle now, or our recovery since the last financial crisis between 2007 and 2009 versus other recessionary periods or weaker market periods as well. And you'll see the decade between 90 and 2000 certainly was, in terms of time, similar to what we've felt so far in this growth period. However, the growth was much higher. So again, this doesn't speak to we expect a higher rate of growth or we expect a longer duration in terms of time within our growth cycle. It just goes to show that it's very data dependent, really driven by what's happening in the market at any given time, and not necessarily driven by time. So not something, again, that time will kill in terms of where we find ourselves today. If we look at volatility, you can see we go back all the way to early 2011, where we saw the European debt crisis. And since that point, up until early 2018, volatility measured by an index called the VIX has been relatively subdued. And we saw it flat, essentially, and then we saw some inflation concerns as well as rising rates into 2018, which did prompt higher volatility levels through 2018. And this is something we expected. We saw that on the horizon, and that prompted us, of course, to also trim a bit of profit throughout the year, as we did rebalance portfolios throughout the year and trim some of those profits and redeploy capital into safer areas of a portfolio. But it also prompts us to feel that volatility will continue, and albeit not at the levels we saw, whether that's Christmas Eve, where the market was down significantly, or Boxing Day, where the market was up significantly, but we do believe volatility will normalize, using air quotes there for those who can't see me. because volatility is not a bad thing for the overall market. And what we've experienced, that lull period from 2012 to late 2017, is certainly not normal in the broader context. If you look at equities and the valuations of those stock prices over time, going back over the last decade or so, what we're looking at, again, that goldish greenish line representing valuations, or the price we pay for earnings, and the dotted purple line representing earnings on the back of companies. This is based on world global stocks. What you'll see towards the end of this chart between 2017 and 2018, that dispersion, or the change between the purple line and that goldish line, really representing a typical investor not willing to pay as much for a dollar's worth of earnings than they have in the past. So this basically says for every dollar's worth of earnings, an investor would normally pay about $14. Historically, that has been higher than we saw at the end of 2018. And it could be argued that valuations are a little cheaper at this point, but again, dependent on our outlook, which we'll talk about in a little bit, and how we're positioning the portfolio, of course. On the back of that, we'll see where the returns from the stocks or the underlying equities come from. And if you go and look in 2017, much of the return, there's really three elements to return in the stock market. It's either earnings growth, again, what a company earns, and then what that person is willing to pay. That comes to the PE expansion, the price to earnings expansion, and then the dividend yield, essentially the cash flow that we receive as investors for investing in those companies. And you can see in 2017, much of it was earning growth, healthy economy, healthy companies, increasing their earnings, increasing their revenue streams. We saw that as well in 2018 with solid earnings numbers, but again, we saw investors willing to pay a little bit less for those earnings. And then in the Q4 of 2018, investors really telling the market that they're not willing to pay for those earnings as much as they have in the past. And part of that was not only on weak earnings, because we actually saw record earnings coming out of a lot of companies towards the second and third and fourth quarter of 2018, rather expectations going forward, that earnings would be weaker going forward, and the market really preparing for that fact should it come to fruition. So you'll see here, again, on average, what as an investor, people have been willing to pay for a dollar's worth of earnings. And currently, or towards the end of 2018 for U.S. stocks, as this is based on the S&P 500, it's just shy of $15. Again, that really means that for every dollar worth of earnings that a company generates, an investor is willing to pay $15 for that earning. You can see the averages, again, going back over the last decade, slightly higher at 15.6 times. Over the last 25 years, towards the end, they're about 17 times. So we're certainly not at the averages, and certainly below them at this point or towards the end of Q4 of 2018. And maybe speaking to valuations being a little cheaper than they have in the past, or maybe fairly valued as well.
And just on that point, I mean, whenever there's a big market dip, and this whole market saying about buy low, well, it actually does work. If anybody bought on Boxing Day, they'd be very happy today, because, that's when the Santa Claus rally happened a little bit late. It didn't happen before Christmas. It happened on Boxing Day. And then since then, things have been generally very positive, because market sentiment has changed around the views around interest rates, how aggressively they're going to move up. The U.S.-China discussions have improved. There seems to be some positive movement there. So, we're seeing a pretty significant rally, and like I said, January is the best month for Canada in about 40 years. So, you gotta look at these kind of numbers and just see when there's good value in the market, and then be prepared to lean in. Casting your emotions aside.
So if we shift our attention now to the bond market, here we'll get a sense of what we call the U.S. Treasury yield curve, and it shows over a period of time. This chart going back to 1976. What the yield has been on those U.S. Treasuries over a period of time, and those blue highlighted periods in between really representing U.S. recessionary periods. Now, the point of this chart, if you were to look at those purple circles, represents a point in time on the yield curve, something we call yield curve inversion. And what that means, so a normal sloping yield curve is upward sloping, meaning short yields, so bonds that have shorter term maturities, 2 to 5 years, have a lower yield or a lower interest rate than long-term maturities, 20 to 30 years, and that's that upward sloping yield curve. A point of inversion happens when your short-term bonds yield or have rates that are higher than your long-term rates. So that would mean the 2 or the 5-year bond pays you more as a yield than a 20 or 30-year bond. If you look over time, that inversion of the yield curve has been a good indicator of prompting recessionary periods, and you can see through each of those blue highlighted areas, there has been an inversion prior to that point in the market cycle. Now, I think it's also important to note that, as we'll see on the next slide, although we believe and see that the yield curve has been and gotten flatter, we certainly don't expect an inversion in the short term. And again, to Mike's earlier point, not expecting a recession in the short term, although there are certain catalysts in the market that could pull that forward, bringing it as close as 6 months out, pushing that ahead. Again, timing really unknown and very data dependent. If we were to look back historically, a lot of it is based and built into what we believe policy is done or has been done in the past, and the probability that there could be a policy error, specifically with the U.S. Federal Reserve Bank in the States.
Yeah, and essentially that means if interest rates go up too quickly, too much in a short amount of time, that could be the top thing that drives us into the next recession. And when you look at some of these points of inversion, notice that the recession doesn't happen right away. I mean, if this happened towards the end of 2005, it took some time before the recession started to hit in 2007 to 2009. And for Canada, the recession didn't really hit until the middle of 2008. So, that's where we're saying the recession could still be 2 to 3 years away. It could be a mild one, depending on what monetary policy looks like. But it's something that we have to be mindful of. And we're certainly a lot closer to a recession today than we were a few years back.
Yeah, and on that point as well, I mean, the Fed's, a while ago, or not a while ago, but prior to the most recent sort of discussion that the Fed chair gave, they were saying we're going to be raising rates at a fairly good clip, and that to them was an indication to the market saying that we feel that the economy is really that the markets are doing well and everything. But then all of a sudden, when they come back and say they weren't going to raise rates as quickly as they had originally said, that just says that the market can't sustain those level of rates. And for them to have continued on the path that they were on, I think what you just said is very true, that it would have just driven things into a recession, because if they kept on raising rates at the pace that they were, it would have been a serious negative.
Yeah. And to that point, Scott, if you look to the peak of that equity market chart that we looked at on October 3rd, that was based on a comment that you just mentioned in terms of what that rate will be and what their policy will be going forward. And in early October, the Fed had said at that time that we were nowhere close to the longer term rate. And I think that scared the market a little bit as well, knowing that it may be unsustainable if they were to increase rates from that point. Their more recent comments have been a little softer, stating that we're probably closer to that longer term, what they call a neutral rate, which has surely helped the market, give them a little bit of comfort in a longer term strategy again. So if you look to the Canadian dollar, you'll see the longer term average there going back to 1970, about 84 cents. Current at the end of Q4 at 73 cents, just above that number today here in February at 75 cents. Longer term average you see there reverting back to that slightly, and that purchasing power parity, meaning the rate at which the Canadian dollar versus the U.S. dollar, which makes those goods equal in cost essentially, has been about 80 cents. And what you'll notice with the dollar in most cases is it does swing like a pendulum, sometimes too far on either side, but we're certainly below our longer term average. at the lower bound around that 75-cent mark today. So if we look at more economic factors driving the market, you'll see the market cycle that Mike talked to in the early slides here, and where we believe we are. And you'll see that green dot just on the cusp of that contractionary, what we call that contractionary period, where positive growth is still happening, although it is slowing. As an example, we don't expect the U.S. economy to grow at 3.5% as it did last year, but it is not negative, and we do expect positive growth in between 2 or 2.5%. So that certainly gives a sense that it is slowing, but we don't see it becoming negative, at least in the near term. But as Mike mentioned, we are closer to the end of this cycle than the beginning, and we will see that recessionary period come to fruition at some point. But really what that means is a good opportunity to lean in a little harder as we've prepared and are preparing for that part of the cycle, and we'll certainly lean in when we see that on the horizon as well. So if you were to look at the three real metrics of the global environment, whether that's economic growth, which is slowing, as I mentioned, becoming weaker over time, inflation, which is lower and not expected to increase as a significant margin going forward, as well as monetary policy. And I think we believe the greatest risk lies within the U.S. Fed getting the policy decisions wrong or having a short or longer term error. So in an area where they're tightening, meaning rates are going up, or they're what we call shrinking their balance sheet because they are no longer putting money into the market in a period where economic growth is slowing, that could be a catalyst for a weaker period in the economic cycle, and would lead us to that downward sloping part of the cycle that we just looked at, or that contractionary period. So where are we? This going back to 1981, and you'll see a bunch of numbers there surrounded by boxes. The boxes represent a larger cycle, and the green line, as well as the numbers, represent these mini cycles in and amongst these broader cycles. And you can see for the period, and then the gray shaded area is representing recessionary periods. So you can see in between each recession, there's certainly a cycle, and it's positive, and it follows that pattern of growth as well as contraction. But you'll also see it's not as simple as that, because it's not as simple going up and let's go down. It's really more complicated in terms of there could be more than one cycle or a mini cycle in and amongst a broader market cycle. And if you go back to the period of the early 90s to the year 2000, you saw 4 mini cycles. And if you recall where we are in terms of time versus historical growth periods, that was the greatest potential rate of growth for that cycle, and it lasted just as long as we've lasted today in our current environment. And then towards the end of this chart, you'll see we're just on the cusp of the third mini cycle within our larger cycle, which again leads to the question, will we see another mini cycle, or will we see this really being the end of the fuller cycle? Again, much of that data dependent, and much of that driven by decisions made by the Federal Reserve Bank in the U.S. and other things of uncertainty like U.S.-China trade. So growth, I mentioned growth was slowing, but again, it's not negative. It certainly continues to be positive and strong. So this represents a purchasing managers index, and anything above that orange dotted line above 50 means growth is increasing, and anything below means growth is decreasing. Again, you'll see those recessionary periods shaded in gray, representing weaker growth below that 50 number. Where we stand at the end of 2018, just above the 59% or the 59-point mark. The second strongest, if we were to go back and look at 2004, and if we didn't have a bit of weakness towards the end of the year, it certainly would have topped out above that 59.1 mark. So this is a longer term expectation marking of where we believe Fed policy lies. and the purple represents estimates, what the Fed has shared in terms of what the longer term rate should be and what they're working toward. The orange dotted line represents what the market has been or is priced in terms of where those rates will lie at a future point in time. And the gray, that 2.75, that's more of the long run, or what we call the more neutral rate. So as you can see, the Fed is postured or shared that they still see the market on the cusp of rising rates, although they've decided to take a pause from here. What they do in the second half, again, will be largely data dependent, but you can see that dispersion between that purple and the orange really representing the probability that there is a policy error which could be negative for the market should they continue to increase rates, and the overall market feels that is unsustainable. Scott, to your earlier point. So you saw oil prices, the weakest asset class going back to 2008, and there you'll see in gold on the top chart there, global or crude oil, and then that purple dotted line representing Canadian Western oil. And you see the main issue with Canadian energy or Canadian oil, and you'll see the price that we sell at a discount versus our U.S. counterpart is really based on transportation and the added cost of getting our oil to market, whether that be rail or potential pipeline as well. And that forces a reduced cost as well, and certainly hurts the overall economy, Canada being very commodity dependent, especially where energy is concerned. And you can see on the bottom chart, rail shipments for energy generally have increased in 2018 versus 2008. And just a tidbit, if you go back and we think about pipelines or the province of Alberta, towards the end of 2018 bought about 7,000 rail cars, and that's an attempt by them to get Canadian oil, their product, to market faster in the hopes of selling it on par or close to par versus our U.S. counterparts. China has also been a major headline if you've turned on the television or opened a newspaper recently as well. And this shows that same manager purchasing index driven by manufacturing, but focused on China. And you do see we are now slightly below that 50 mark, where again, China is contracting. Part of that could be the impact of the tariffs as well as U.S.-Chinese trade. So again, that uncertainty weighing heavily on that part of the world.
Yeah, so we covered a lot of ground. I don't know if there's any questions at that point, Scott, but we can certainly carry on and talk about what does this all mean, and in terms of how we're going to position the portfolios.
Yeah, well, I think this is this is exactly what we need to sort of. I think people are asking the question now. Okay, so now what? Now we recognize there's a time to be cautious, and it's probably a time to be a little bit cautious now. So what so-called keep your powder dry and get ready for some events that might encourage us to lean in. So what's the plan going forward?
Yeah, and the markets always have good, bad, and ugly things. And Brian showed a bunch of charts about earnings and purchasing managers index and things that are really still quite positive in the market. And certainly valuations have come down a lot, so that usually leads to good buying opportunities. Having said that, we do see increased risks in the market as well. And this recession that we've talked about, it probably will happen. Will it be mild? Will it be a soft landing? Will it be a hard landing? Time will tell. But we need to watch these things really closely. But here's our crystal ball page, and you can see at the top you've got all our different equities that we can invest in, different kinds of fixed income, alternative investments. We certainly favor right across the board. So where it's suitable for clients, we think that clients should consider that. But if you're just looking at the stock and bond decision, we certainly favor global equities over Canadian equities. And you can see, this is the minimum we might invest, this is the maximum, this is kind of a neutral weight. So we're underweight small companies and large companies in Canada, overweight large companies in the rest of the world. And small companies is our favorite area to be. But small companies, just a few months ago, was a significant underweight. And we've added to it in part because of how beaten up that market was last year, and that served us well. Year to date, small caps have been one of the areas that have led the way out, and Canada has been the dominant market so far in this recovery. And across fixed income, we never really like cash a whole lot unless somebody desperately needs the money and wants it guaranteed. But in the fixed income space, we're favoring short-term bonds and core bonds to high yield, in part because there's more risk associated with companies, and the spread between high yield bonds and government bonds has come down a fair bit. So we're biased more towards the short-term space and core bonds. To elaborate on some of this, what that means within these areas, even though we're underweight Canada, within Canada, we're slowly reducing our exposure to cyclical exposure, stocks that are tied to the business cycle and the economy. We're buying more larger company names with lower leverage, stable earnings. Similar themes in the global side, which we favor over Canada. But we're reducing cyclical exposure, buying higher quality companies, underweight financials and materials, because that'll provide us a more defensive stance in case things get more difficult in the market. Fixed income, I already mentioned that we're favoring core short-term bonds, but we're underweight commercial bonds and provincial bonds a bit right now, and we've shifted our high yield to even more quality. So triple B is essentially investment grade. It's like a B plus at school. Large institutional clients will invest in these kind of bonds. Versus normally we might be double B, which is still a good B, but triple B is like a B plus. So we're improving the credit rating. In alternative investments, real estate, we're looking to improve the existing assets. We've already got a very diverse portfolio, about $4 billion, 215 plus properties in the portfolio. We made some new investments recently. Infrastructure, we're looking for a more diverse range of opportunities. We've got a massive pipeline of opportunities we're bidding on, so we're hoping to be able to deploy some good amount of capital this year. And private loans, it's become a little bit more competitive with the banks coming downstream and offering very competitive rates for what they would deem to be higher risk loans. So we've had to become very selective as to what we want to get involved in, because we want to maintain the returns at that 7 to 9% range that we've talked about in private loans. And with real estate, it's 8 to 11 is our objective. So in general, if you look at the markets, there's certainly some things that are very positive in the market right now. There's some things that are more concerning. But I think it's always important to remember, when you look at different time horizons, the percentage of time stocks are positive is very high. I've often used the stat of 2/3 of the time the market goes up, 1/3 of the time it goes down. Sometimes it's 2 steps forward and then you take a step back. Sometimes you take a step back before you take 2 steps forward. But the actual stats are even more impressive than that. When you look at 79% of the time on a 1-year rolling average basis, stocks are positive. Over 3 years, that goes up to 86%. Over 5 years, 97, 92. And over 10 years, there's only been a few time frames in around the Great Depression where you lost money on a 10-year basis. Over 15 years, there's never been a time where people have lost money in the markets. So those statistics are pretty positive. We don't call that gambling. That's just sensible investing. If you build a strategy, invest for the long term, and you stay in the game, you will win over the long term. And there's going to be some short periods of time, like Q4 last year, where you're going to take a step back before you take a step forward again. But it's hard to beat these kind of odds when you invest. And just to put this into perspective, if you just invested in an equity market portfolio over 20 years, you're doing nothing. You would have done a 10% rate of return. But the average investor somehow, tinkering with things, motion comes into play, moving money in and out, has turned that return into 4% by investing in the same things, but just, looking at their behavior over that time frame. So that's a 6% gap versus, versus if you just put your money in and stuck with your strategy long term.
It's so interesting with the behavioral side of investing, because that is really probably one of the biggest costs to a portfolio, are making bad decisions at bad times. When people can, I like the fact that you've got these two charts on the same page, because it really does show, the U.S. market 79% of the time, over a 1-year period is up, but over 10 to 15 years, it's pretty much up all the time. So these short-term, I call them opportunities, but these short-term adjustments that take place, that's just the market. Just what the market does. The market needs to be doing that. The market will move around because of the emotions and statements that are made from the feds and the government and all of the stuff that drives the market return. But it's the behavioral side of how do you train yourself to be a better investor. And a lot of it has to do with making good decisions, logical decisions at the right time. And I've always said that if you let emotions dictate your investment making decisions, you'll be wrong, 100% of the time, because it never feels right to do the right thing when you're talking about investments.
Exactly. And looking back, it's easy. Everybody should have invested on Boxing Day, but was anybody thinking that? Probably not.
Yeah, because emotionally, that's it. Emotionally, Boxing Day felt like or not Boxing Day. Was it Boxing Day or was it Christmas Eve?
Christmas Eve.
Yeah, it was Christmas Eve.
Christmas Eve is when things turn around.
Yeah, and so it never feels right at that point, and it's almost like you've got to train yourself from a behavioral standpoint to say, if I feel really, really uncomfortable, it probably is the right time, and that's just the difference between emotion and logic. So it's a huge cost. I mean, that's a big differential there, and I don't want to spend too much time on this point, but people are spending time on and there's all this analysis saying the cost in a portfolio, the MERs, all that sort of thing, and that definitely is important. But nobody's really talked about the cost of poor investor behavior, and that cost is significant. Right here, we're seeing that cost being 6.2%. So how do you reduce the cost of investor behavior? And it's perspective. I think it's having a counsel or counseling people to gain that longer term perspective and to really encourage them and support them in maintaining that focus. But it's difficult. It's not easy. That's for sure.
And you know what, things have moved up significantly now in January. So the right time was Christmas Eve, Boxing Day. Anywhere around there would have been a good time to invest. But it's still a good time to invest. Markets are still way down compared to where they were on a 1-year basis, 6-month basis, and everybody has to make their RSP contributions, tax-free savings account top-ups. Why wait? If it's down and you have to do this anyway, you're going to buy anyway. So why not buy low?
Well, yeah, and and on that one point, and we can cut it off after this, but on that one point that if based on the numbers you've just shown, that in 15 years, there's 100% historically 100% of the time, the stocks have been worth more in 15 years than they were today, then it's always the right time to invest. And that comes back to Sir John Templeton. He says the right time to invest is when you have the money.
Yeah, that's exactly right. So a couple quick updates. Anybody that's committed to these alternative investments has seen capital calls coming through, and we've had a lot of activity recently. Real estate, we just bought a couple of buildings, Ford Canada building in Edmonton, the Canal Industry Park in Calgary. In infrastructure, we've had capital calls for a couple hydro projects, and we added money to our portfolio of solar investments in Chile. So we now have 32 megawatts that's being generated across a number of different projects in that market. And we've got a bunch of things that are under construction stage right now, like the ring roads in Calgary, the Regina bypass, and all of the solar projects in Chile are underway, and they're progressing very well. I mean, the projects are advancing on schedule, on budget, which is exactly what we want to see. And as once they're built, that's when we can start producing power, start having people drive on these roads, and that's when the provinces and power authorities will start to pay. And that's where we'd expect to generate a long-term stable tax efficient cash flow in return for our investors. Private loans, we also had a capital call there, a couple large ones, a $60 million a loan and a $25 million loan to a couple of different Canadian companies. So, we built the portfolio to 4 loans. One got paid back early, so we got 3 loans in the portfolio now. We're still working towards building that up to 15, 20, 25 loans in a diversified way. But all these loans are taking a very positive interest rates. And as interest rates have gone up, we've made more money on it because we hedge these loans to rising interest rates. Essentially, we put in place floating rate contracts. If interest rates go up, we get more. And we also have security against the assets and operations of these businesses. So we like the security, we like the higher yields, we like the interest rate protection in a rising rate environment. And we're still in the camp that the rates are still moving up a little bit this year, albeit slow, but we think rates are still rising. So when you sum this all up, you got all these different tools in the toolbox. This is how I started the presentation. What are our 20-year forecasts? What do we think is going to perform better? What's the risk look like? And at the bottom end of the curve, on the horizontal axis, you can see the volatility. On the vertical axis, you can see return. So Of course, we want to be up in the northwest quadrant. If we get 10% with zero risk, we'd all sign up. That doesn't exist. So you got to buy somewhere on this curve if you buy into our forecasts. More risk, more return. Except for in real estate, hedging strategies, infrastructure, and private loans, where all those numbers are above the curve, which is saying it's either less risk or more return or both than other things you can invest in. So in isolation, each individual asset class looks really attractive, but when you put it into a blended portfolio, and it doesn't even require a significant allocation, just 5% each to real estate, infrastructure, and private loans takes a balanced investor's return from 5% to over 6% with less risk. So, I think if everybody's given an opportunity to get more return with less risk, people are going to say yes to that. What's the downside? The downside is some of these asset classes are not as liquid. They take 3 to 6 months to get money out. It's inconvenient, but which is why we only recommend 5 to 10% each, up to 20 overall. But when you look at that, what kind of portfolio do you want to have when the next recession hits? We'd argue you want to have a blend of traditional and alternative, private and public market. That's how the pensions invest. So that's how, in our opinion, the average investor should invest, subject to it meeting their needs. So that's kind of the punchline. Bit of a legal disclosure here, and up front, I should have mentioned that Ryan and I've shared a lot of our own opinions as well as the opinions of the firm. And if you want to talk more about any of this, we're happy to sit down with people on a one-on-one basis.
Well, that's fantastic, guys. That was a very complete. I mean, it when the size of your toolbox is so big, it requires a longer conversation because there's more to talk about. So I appreciate you taking the time and going through all of that. It really does put some perspective into what's been happening and then what plans are going forward. And I think it really just paints a picture that the diversification is important. The taking advantage of the opportunities that they present themselves is also important, but also just getting money invested. And as you have the money, you get it invested. And over the long term, it works well. It's just the short term sometimes can cause a little bit of uncertainty, but that's where the behavioral side kicks in. And if you've got good behavioral traits and you can understand what those traits are and use logic to your bring logic to your side as opposed to letting emotions dictate the decisions, it all works in the long run. So that's great. I appreciate you taking the time.